Hello, I'm Brendan Coffey, the sports finance reporter for Sportico. Today on Sportico Teaches, we're talking about private equity. Private equity is a collection of investors seeking deals, usually in closely held businesses, stuff that isn't traded on the stock market. PE firms take money from a wide variety of deep-pocketed investors, sovereign wealth funds, insurance companies, endowments, pension funds. They also take investment from some very high net worth individuals. Private equity firms look to make outsized financial returns by investing in things that need a lot of time, 5 to 10 years, and also aren't easily traded like a stock would be. PE firms also think that by bringing their expertise into the business, they can help create value that otherwise wouldn't be there. Probably the most famous private equity firm is KKR, which took Nabisco private in a $25 billion deal in 1988, and is really seen as really setting off the PE boom that's happened since. In sports, private equity sees two opportunities. One is that extraordinary growth in value of teams means that they're one of the few buyers left who can afford to buy into sports teams. Over the past 20 years, the value of the average NBA franchise has increased 850%. The average baseball MLB team, 450%, and about the same for the average NFL team. That means there are fewer and fewer billionaires who can afford to buy a franchise. In particular, that means there are far fewer people who want to buy a minority stake in a team. PE sees their role as being able to buy these minority stakes in teams and not have to worry about selling in a couple of years, so that they can just sit back and let the value of teams continue to increase, eventually selling 5, 10, 15 years down the line. Another benefit PE likes about sport is scarcity value. There are only so many pro sports franchises to go around, 32 NBA and 32 NFL franchises, and they aren't really making any more. So just from a pure investment standpoint, Wall Street loves scarcity, and sports really offers that. A third benefit that PE sees is a little more abstract, but it's important to the clients that give them money to invest. Mainly, sports is seen as non-correlated with a lot of other assets like stocks and bonds. That means that when the market crashes, sports teams are much more likely to hold their value. That non-correlation is important to their clients, such as insurance companies and pension funds, who really need to plan out steady return over the course of decades. Yeah, private equity sees its role too, not just as money, but as being able to create deal flow between teams and other businesses they have connections with. This is especially true in the area of media rights, in which sports is really seen as key to keep people watching events live on cable and on streaming services. So private equity sees itself as a deal maker between these leagues that need money and sponsorship and some of the other companies that maybe their private equity funds already own. There's a big downside to private equity, at least in the eyes of fans. One is that they're going to take their beloved sport and change it in a way that makes it much more commercial and much less fun. A great example of that is the Super League proposal, in which private equity funds have proposed to back a new tier of top European football clubs, including Manchester United and Barcelona, that would be in their own league apart from their national leagues. The benefit for the teams and for the private equity investors would be more media money, that they'd be able to sell more games to media partners. The downside, in fans' view, was the downside to fans. The downside in the view of fans was making their sport more corporate and eliminating a lot of games in traditional rivalries that they have grown to love. Not every league is taking private equity money. For one, the National Football League doesn't allow institutional investors like private equity to own stakes in their teams. So that's still an area that private equity wants to get into, and the NFL may or may not allow institutional money to buy in at some point down the line. That league wants to see how it goes with the NBA, MLB, and the NHL. I think we're also going to see, I think in the future, we're also going to see private equity firms that buy whole leagues and run them that way. It's not a new idea. Back when the NFL had a strike a couple of decades ago, Boston-based Bain & Co., a private equity firm, offered to buy the whole league for $3 billion. So it's an idea that's been kicking around Wall Street for some time. Most likely we'll see secondary leagues or less popular leagues. You won't see top-tier leagues like the NFL or NBA being bought by private equity, but I think it's quite possible we'll see smaller, newer leagues being bought whole by private equity, and with the aim of building them out over 10 years and selling them off to the highest bidder in pieces. I think women's sports leagues are ripe for private equity investment too, because one, they're already playing a popular sport with a big fan base, but haven't forged long-term media deals, and also in some cities don't have deep roots like some other teams in more established leagues. Thanks for watching. This has been Sportico Teaches Private Equity. Subscribe here for more content.